Busy week ahead for traders as eco data comes out this week, and we have the midterm elections, of course, to watch out for. What's going to happen after the elections to markets, and what's going to happen after the CPI data comes out? These are the themes of our discussion with Bill Baruch, president of Blue Line Futures. Welcome back to the show, Bill.
Thanks for having me on again. It's always a pleasure to join you.
I do have to congratulate you on your inflation call that you made with me a couple months ago. You were on the show back in June, and now back in the summer, you spoke to me during peak inflation. And since then, like you said during your our last interview together, you said that you expect inflation to come back down and the Fed to react accordingly. Take a look at what you said back then.
I do expect it to come down. I'm positioning with my clients on the futures trading side, wealth management side, for this to come in. It's just a matter of what does the data tell us. However, if it doesn't come in, this is that inflation showdown in August, because we'll have numbers for the CPI in July for June, and in August ahead of Jackson Hole for July. If it doesn't, we could see a very hawkish move from Fed Chair Powell.
All right, so a couple of things you said there. So first, let's talk about your expectations back then for inflation to come back down. In some senses, you were correct, especially when you take a look at headline inflation. Headline inflation peaked at 9.1% in June and has since been trickling down. We're in the mid or lower bound of the 8% range. Now, Bill, is that still a considerable or even significant decrease for you? Because you did say that should inflation remain elevated, the Fed would maintain its hawkish stance. Well, we've seen what happened since June, 2 more rounds of 75 basis point hikes, right? And, it just doesn't seem like the Fed is giving up its hawkishness.
Yeah, I mean, they're not. They're staying pretty steady. And, they're, at the end of the day, they know that they can't back off their hawkishness until they're actually ready to really prepared to kind of take that step back. I mean, right now they're still in the later innings of these excessive hikes, 75 basis points last week. They've done some really great transitions. I mean, obviously we can pick apart their mistakes going back to last year, but done a pretty good transition and staying hawkish, but as well, getting the market ready for less of a hike in December. Now, it's fun to be right and call numbers that like a CPI, but at the end of the day, my job is to make money in the market. And, so it was fun saying, hey, inflation is going to slow down a little bit. The June numbers in July, when I was on your show in June, I said, hey, listen, we're using this June weakness to really position heavily and get money to work. And the rally took hold. The S&P rallied to the 200-day moving average. That's my job. That's really what we need to make sure we capitalize when we're right in the market. But at the same time, as I noted in that previous interview, if the Fed stays hawkish and inflation doesn't back down, which it didn't back down, that August number in September was smoking hot. And we were actually ready for that. The risks during the market holding at that elevated level, the risks were to the downside. So it's fun being right, but you've got to look at how you've got to position in order to capitalize in the market and capitalize when you are right and stay nimble. So that's really, this year is really all about staying nimble. With inflation later this week coming out, it's still holding at 0.8. They're looking for headline inflation to increase month over month at 0.8. That's the Cleveland Fed inflation nowcast. So inflation's not backing down. But there are, because there's sticky portions of this, which is the rents, the owner's equivalent rent. What I do expect owner's equivalent rent to start coming in the first quarter, but it's not coming in right now, and it's 1/3 of CPI.
Okay. What about the base metals front? We'll come back to the shelter side of CPI, but some would say that the base metals are perhaps a leading indicator for where inflation overall is headed. If you take a look at copper, for example, came back down in June, bottomed around July, and incidentally, it's more or less had a close correlation with the rest of the CPI index, which is relatively flat since the summer. What are base metals telling you in terms of where the overall commodities complex is headed, and of course how that impacts the rest of the prices in the economy?
We're long metals. I'm long metals in the commodity fund that I trade. We got good positions in things like gold, silver, copper, and platinum. But touching on copper, because you brought it up first, it was a heck of a rally on Friday. It was up 20 some cents. I mean, I don't know, but it was probably a historic type move, maybe only matched by something, a big risk on move day coming out of the pandemic. But copper really rallied sharply, and it got it back up, actually touched 370, back down a little bit today. So as you're talking about inflation, China reopening, and are they going to reopen? Are they going to make it easy for travel? Quarantine wise, and some of the narratives that are going on right now. And copper really was underpinned by that news that China's going to open up to Hong Kong in the first quarter. They're going to potentially open up to international travel thereafter. So the market really ready for it. That's a reflationary trade. So you are right in saying that copper is a signal of inflation, and it's been down here as inflation sort of has moderated. At the end of the day, I think that the Fed is preparing for the shelter, the rents to come in. They know they can control the market from the stocks side or commodity side. They've been able to suppress those prices, not so much on oil, but there is what's going on in Russia and Ukraine, that war. But other parts of the market, other commodities have been smoked over the past few months. They're down about 20% from the Bloomberg Commodity Index is down about 20% from its June peak. And it's kind of just hanging in this area, this lower bound area for the past 2 or 3 months.
Okay, let's talk about shelter then. Now, mortgage rates have been spiking up in line with the rising federal funds rate. In fact, mortgage rates have not been higher for the last 12 to 13 years. This may be concerning for a lot of people who can't afford their variables going up. But I've also heard, Bill, from other traders who have talked about shelter with me, that home prices are going to be relatively stable in the U.S., actually in North America at large. And his reasoning was that there's so much capital, excess capital, just waiting on the sidelines that as soon as house prices correct to the downside, people are going to come in like vultures, swoop in real estate on the cheap and push that way back up. What do you think?
Absolutely. I mean, there are venture capital companies, firms that are ready to be buying houses and assets. At the same time, individuals. I have a lot of clients that are wealthy individuals that are maybe still in a city. They're trying to transition and buy a home, maybe move to a different area and buy a home, and they're waiting for prices to come down. They have cash. We've figured a plan out where they maybe want to get some of this cash to work at this level in the market, but they have cash ready to buy homes. I mean, that's just a small portion. I mean, that of what I have. I mean, in the sense. So I think there's a lot of people out there that are. I think that's a very good narrative. Now, I was also looking at some statistics today that showed that the difference between the current rents and the rents that are that are being offered now, the contracts that people have and the rent that they're paying relative to the price of rents for new rentals is at a big, large difference right now. I wish I could remember this quote. It was just reading it in passing earlier today, but the fact that we're talking about it right now, I thought it was pretty interesting. So it's showing you there's some divergences that are taking place right now within shelter.
Okay, so then generally speaking, let's go over your macro overview. What are you most concerned about right now in the economy, and how are you positioned accordingly? Because like you said, your job is to make money. And previously in the summertime, when we talked about inflation expectations, the most important thing you told me was that you were positioned according to your own expectations, which is that inflation would be coming down. Going forward now, let's talk about your overall macro outlook on where the economy is headed and how you will be positioned accordingly.
Yeah, I mean, right now, we got risk on exposure. So in the wealth management
side,
did you
say risk on?
Risk on exposure, yeah.
Okay.
So on the portfolio wealth management side, where you are positioned with most of our cash to work right now, we continue to thematically rotate, and given the recent move in industrials, which can be really in banks, which really can be seen in the Dow. I think there's good buying or value opportunity here in tech, and I think tech could potentially lead over the next coming months out of this sort of lower bound area, and really going to depend on the rates. I mean, the 10-year did break. 10-year yields broke, so it's this sort of uptrend line, and it's sort of just flirting with it right now. We get rates back below 4%. I think that'd be a catalyst for tech. Commodities in the commodity fund, we do have long equity index exposure as well, but really a good focus on the metals. I mean, given that move that we saw on Friday, started to confirm maybe a bottoming pattern here in gold. Silver's really perking up very nicely. There's definitely a lot of damage that each gold and silver need to chew through, but I mean it's definitely a good start. And if you were long, through for Friday and able to enjoy that, I wouldn't be chasing at this level. I would definitely be taking a little off the table here until to prove otherwise. But I think that we're going to see sort of commodities be reinvigorated with the U.S. dollar, that should roll over a bit more. It's starting to show some weakness. One of the ways we've been hedging in the prior months exposure when we wanted to get long gold and silver is actually being short the Japanese yen. And we're not short the Japanese yen anymore. Some of our targets were hit a couple of weeks ago. So I think, though, that the dollar could roll over a bit. It's just going to really matter on the narrative and then what comes from the Fed. We're going to get a lot of probably Fed speak this week. We're going to see the inflation data. The expectations for inflation are already pretty elevated. So, if they come in a little light or in line, it could be something to really be sort of help this market, big catalyst for it. So I think right now is the time to manage your risk, protect your downside, but you have to be, you have yourself positioned in order to enjoy the upside.
Okay. Now, a couple points to go over. Let's talk about the U.S. dollar first. Now, the U.S. dollar, as you've mentioned, has been very strong all year. You're seeing signs of weakness. Is that from a purely technical perspective, Bill, or are you seeing macro variables that are potentially weighing down on the dollar?
Well, there's definitely a technical perspective there. You can't deny the strength that's there. So a little bit of a contrarian technicals. But with that said, the dollar really typically and historically tops at the onset of a rate hike cycle. And it hasn't happened this year. And that's because the goalposts have kept being moved as inflation remains steadfast. So if you believe that rents are going to come in the first quarter, then you want to be short the dollar. So that's something to really keep in mind. And if the dollar's weaker, commodities priced in dollars are going to strengthen. So, not just gold and silver and copper and platinum, but looking at things like cotton and some of the agricultures out there that I think there's really good value at as well.
Okay. I want to talk about geopolitics for a minute and how geopolitical risk affects certain areas of the market. Just going back to the Ukraine war, and we'll use that as an example, and then we can, expand on that. The war broke out late February. February 24th was when Russia crossed the border into Ukraine. Now, we saw gold immediately spike after that. However, gold was already on an uptrend. If you recall, all throughout early January, it was already starting to trickle up a bit. Now, this trickling action continued all throughout March until it peaked in mid-March, close to $2,000 an ounce. So let's talk about gold first and then the U.S. dollar. Gold, typically, how does gold react to an outbreak of war?
Well, gold is a safe haven. It's going to run. When you get an event, the event typically, encourages that sort of spike. And then that spike, the headline driven spike should come in, and then it did. But if it starts surrendering price action as we saw in April, it went back quickly through 2000. It went very, very quickly back through the 1900s. That's not the sign of something that's going to be stable. Now, with that said, you really want to consider, what's really driving gold as well as the inflation story really stayed. Rates stayed higher, and higher rates are a headwind to gold. But at the end of the day, if you have gold in your portfolio and you're a U.S. investor, it's done really what it's supposed to do, and it sort of led the rally led the inflation story, and before sort of crippling up a bit. And the U.S. dollar, was really what's been the big story this year. But if you're long gold and yen terms or euro terms, it's performed tremendous this year. It's basically at record highs. So it really depends what's your purpose for gold. And I, as a wealth manager, believe that gold has served its purpose, and we do hold it in portfolios.
It's just people are talking about the prospect of geopolitical tensions escalating, and I just want to bring this up because as somebody who's looking at the chart, I have to question the validity of the claim, not just by you, but from other people as well, that gold hedges against outbreaks of war and extreme geopolitical risk. If you take a look at the history of gold, it hasn't really done that to a consistent degree. 1991, the Gulf War, gold didn't go up and went down actually. 2003, the invasion of Iraq, gold was already on an uptrend. And, as we saw in COVID, gold went up, yes, but so did everything else, right? So all I'm saying is that gold doesn't really behave in isolated pockets, at least not historically, to war, right? Would you make that, how would you respond to the data?
Well, I agree with that because, what's driving, what's also there, are rates rising due to inflation factors, or are they doing because we got to print money? The Treasury has to print more in order to in order to fund a war, create more debt. So what other factors are going on? And a lot of the time, if gold's in an uptrend of the outbreak of war, you actually could get a high probability of some capitulatory action where people are already long, and it served its purpose. It met its purpose, and it rallied and as into the headlines of war by the rumors, sell the news. And so I would imagine that it serves its purpose, but it's not going to continue to rise throughout a war.
Correct. All right. So, Bill, going forward, then, do you see any events around the world, geopolitical and/or otherwise, that could potentially move gold dramatically? Besides the Federal Reserve, besides monetary policy, besides inflation and equity volatility, what else could possibly move the goalpost for gold for you?
Well, I mean, I think a reallocation of those who are involved in the market. So maybe that's portfolio managers, finally saying, okay, gold's down here and it's holding 1,600, and we want to diversify a little bit. Central banks also in quarter three were record buyers of gold. There could be other geopolitical instances. I mean, I wouldn't deny the fact if somebody told me the news of North Korea on Friday was a tailwind to what we were seeing in gold and silver. I think it was. So maybe we're starting, something could happen with China and Taiwan that everybody's anticipating. There's a number of factors I think that you want to be long gold. Not to mention not to really open a can of worms, but the miners have been extremely beaten down. And I mean, with gold at these prices, they should be profitable for years to come. So there's definitely some value in there.
All right. Looking ahead at the midterm elections now this week. Now, in 2018, you'll recall that we had a massive correction in October, actually, right around the same time as the last midterm election. I don't know if that was just a coincidence, but let's recap what happened in late October and early November 2018. Markets saw a significant correction. I'm talking about the stock markets, and it rebounded quickly thereafter, but it was a scary period for people trading the markets at the time. Was that correlated at all to politics in the U.S.? No.
And, I've gotten a lot of clients who watch the market too closely.
Yeah.
That's what they pay me for. But a lot of clients who watch the market too closely have heard a lot of just stuff, through the YouTube videos of random, people that put out stuff and talking about the bigger crash that's still underway and things that are going to happen and correlate to 2018. I don't see that. Obviously, it's the important thing is to stay nimble and react to do what the market tells you need to do. But I don't think you can sit here and plan for a 2018 style move down from this level because of the midterm elections. I would think it'd have to come over from some other catalyst if it were to happen. But I look at the midterm elections as historically a very bullish time for the market. And so 2018 was a little different, where you had Powell talk about autopilot. The market had just sort of steadily been higher. Volatility was really low, and there were some things that also that within the market that were almost sort of breaking to some instance. But now, I mean, the market is actually sold off all year. I mean, we're at the lower bound of this. I'm not saying a low is certainly in. We could go to 3,400, but I think the light at the end of the tunnel through the sell-off is here. I think the midterm elections bring seasonally bullish tailwinds. Historically, it's the most seasonally bullish time of year. For the period 6 months to 9 months or so after the midterms. That's when you want to be buying. So I think there's definitely some signs within the market in general right now where the Dow, some of the industrial stocks, the bank stocks, energy stocks, there's a lot of life in there. So again, if rates stop going higher, we see the 10-year kind of maybe decisively get back below 4%. I think it's a catalyst for tech to be the last leg of this, to really get this thing going. But you got to see Republicans take some seats here. And at the end of the day, if the Democrats win this election, which I don't think they will, when they stay in control of Congress, then there's likely to see some more spending, and that could lead to higher yields. So that would be the headwind I would see, but I don't think that's going to be the instance. I don't think that's going to be the case. So I'm pretty bullish right now, looking for this market to move in the coming months.
So you're expecting the Republicans to take over Congress
Yeah.
after this week. What are the fiscal policy implications of that?
More deadlock, and I think that's good at this period of time. Markets, I mean, look, for instance, I wouldn't expect the Democrats, if they wanted to come in with some, what was going to UK style fiscal announcement. That's not it. But just, as an example, the market punished that thought process. So, we don't want to see that, and I don't think that would be the case anyways. But that's just an extrapolated, version of it.
Okay, and finally, we talked about oil last time you were on the show in June. You had said that $200 oil is a possibility for you, and certainly I've heard people talk about $100 being the new norm going forward into the foreseeable future. What's your take on energy? Have you changed your stance since June about where energy prices are going? Because like I mentioned before, even if you strip away energy and food from the CPI index, if you just take a look at core CPI, that's been steadily trending up. So even without the direct influence of volatile assets like food and energy, everything else, including shelter, like you brought up, has been going up.
Yeah. I think oil is going to continue higher overall. We haven't been really invested in crude oil so much in the commodity fund of late, because I am bullish overall. I didn't see, when it broke $93, I think it was in August, we stepped aside. We saw some good value below $80 for a great trade. But really, we need to see this thing back above $93 in order to bring some light to the market and break the trend of lower highs. And that's what we started to see. Today, we're falling back a little bit. But I bought some call spreads in crude oil on Friday, early Friday morning, to have some exposure in case this thing could keep running. Overall though, but we got to hold $90, sort of, kind of establish a floor there. When it comes to the portfolio side, in securities, we were very overweight energy stocks. They've just performed tremendously in the recent weeks, and I mean, obviously for the recent 2 years, but some really terrific moves there, and I would imagine it continues.
What's the the long-term impact of elevated oil prices on consumer sentiment and expectations? Because the economic theory teaches us that if oil spikes temporarily to $120 or $140, whatever the case may be, that doesn't really put a dent on expectations long-term, because people expect that to come down eventually. And they can, they don't have to make adjustments to their spending accordingly. But if you have oil staying elevated above $100 a barrel for the foreseeable future, I'm thinking to myself, assuming my wages don't tick up in commensurate proportions, I'm thinking to myself, Bill, that's disastrous. Not only is my heating bills possibly going to go up if I use natural gas, but my car, my gas bills are going to go up. Everything else related to fixed costs of energy are going to go up, and I'm going to start cutting back down everything I spent. Discretionary spending is going to go down. Perhaps I may negotiate for a higher wage, and if I get that, that's going to keep inflation sticky. So certainly not great for discretionary spending. Certainly not great for the broader inflationary outlook. I would argue that higher oil is just really disastrous for the economy overall. Would you have a counter argument to that?
Yeah, it's one of the reasons why we're underweight consumer discretionary. And I claim that that, as long as supply chain concerns and whatnot, but I do think that that is a big headwind to the economy if oil were to stay higher, and I think it does stay higher. But I do think people get used to a higher, sort of immune in the psychological sense of it, of higher prices at the pump for a little bit longer. I mean, the White House has unloaded this SPR. It's going to lead to higher prices. I mean, they're going to have to sort of replenish it. And the industry is just overall very underinvested right now. You have some steep backwardation that's still there, and so I think the underinvestment is going to be something that's not going to change in the near term, and I think it's going to underpin higher prices for longer. Like I said, I think we were in a very choppy environment that had value below $80, but now if we can hold out above 90, then this could be the start of a new leg higher.
Okay. Final question. I'll let you go. Risk on. You said you were more risk on right now. What is your favorite sector? You said you don't like consumer discretionary. How can you be risk on without liking one of the core cyclical sectors?
Well, I think the exposure I can be seen and realized through tech right now. We put cash to work in tech. So yeah, underweight to consumer discretionary, but obviously, stocks, companies like Apple and Amazon are going to be a heartbeat to the consumer. I think I really like banks overall. I think they performed very well in the first quarter. I think the yield curve is going to steepen a bit when inflation potentially normalizes on the heels of rents. So I think there's definitely some really great aspects of the market. But speaking of cyclicals, I mean we love industrials as well. So I think there's really some great value within there. Overall, like I said, I think there's a risk on move building. The Fed kind of threw it for a loop last week, and but nothing really changed. I don't think there was anything new that came out of Wednesday or Friday's non-farm payroll report. So this morning the expectations were leaning on a 50 basis point hike for the December rate hike by the Fed with better than 50% probability. If that stays the course in there, and you see those probabilities stay above 50% for a 50 basis point hike, then I think we see a risk on rally.
Perfect. Bill, thank you so much for your thoughts. Appreciate it.
Thank you. Thank you for having me.
Thank you for watching Kitco News. I'm David Lin.